Good morning, good afternoon, good evening. Welcome to this Q3 2021 Global ACS webcast. I'm Marie Kling. I'm a partner in our global accounting team. And today I'm joined by my fellow partners from the global team, Gary Berchowitz, Scott Bandura, and Paul Shepherd. In this Q3 webcast, we're going to cover several topical issues. We're going to start with cloud computing arrangements and a discussion of configuration and customization costs in such arrangements. We'll then move on to the topic of climate risk and expected credit losses under IFRS 9. Then we'll have key reminders about a reversal of impairment losses under IAS 36. And we're going to finish this webcast with a discussion of pollutant pricing mechanisms. Please feel free to use the timestamps in the description below the video if you want to go straight to one of the topics we are discussing today. Happy accounting!
As we've highlighted in our previous webcast, there were two agenda decisions, one in March of 2019 and another in March of 2021, dealing with cloud computing arrangements and specifically software as a service or SaaS. Please refer to our June 2021 webcast where we covered what SaaS arrangements are and how they're generally accounted for, how to account for customization and configuration costs performed by the SaaS vendor, a third party, or the entity themselves. And this also included cases where the upfront cost could result in an intangible asset or a prepayment or an expense. And finally, we also covered when the March 2021 agenda decision is effective and how that might impact entities' period-end financial reporting planning. Following on from these agenda decisions, we've been considering other costs associated with a SaaS implementation that might not be customization or configuration costs as they were defined by the IFRS Interpretations Committee when they looked at this. And as in previous webcasts, I'm going to refer to customization and configuration as CC costs. Just rolls off the tongue a little bit easier. Now, entities will still need to carefully consider IAS 38's requirements, and some of these other costs might still result in the recognition of an intangible asset. Now, folks may recall an intangible asset is defined as an identifiable, non-monetary asset without physical substance. And an asset is a resource controlled by an entity, and an entity controls an asset if it has the power to obtain the future economic benefits from the underlying resource and to restrict the access of others to those benefits. Now, IAS 38 doesn't provide much guidance about identifying the unit of account when trying to identify intangible assets. And by unit of account, we mean whether these other activities related to a SaaS setup need to be run through the IAS 38 criteria on their own, or whether they form part of the CC activity that was defined by the Interpretations Committee. IAS 38 does provide guidance about the identifiability of intangible assets and goes on to say that an intangible asset is identifiable if it is separable. So in other words, it's capable of being separated or divided from the entity and sold, transferred, licensed, rented, or exchanged, or if they arise from contractual or other legal rights. And therefore, it can be difficult in many SaaS arrangements to identify the separate activities or components in a SaaS setup which should be assessed as a separate unit of account against the guidance in the intangible asset standard. So let's have a look at some common examples to hopefully bring this to life of other types of activities that might need to be assessed separately from the CC activities for capitalization. Now, some of the activities we think would typically be expensed as incurred might be modifying the SaaS source code to change or create additional functionalities where the IP over the source code is retained by the SaaS provider. Data migration, data cleansing, or data conversion would be other examples, and training costs as well. Now, activities we think would typically be assessed against the IAS 38 criteria and that might be capitalized might include incremental work done on the entity's own software or systems in order to prepare for the SaaS, and purchased or developed data conversion software, although this might have quite a short useful life if it's capitalized, if it's only going to be used for the SaaS implementation. Now, we think developing additional source code over and above the SaaS source code, so that includes modules or interfaces, that is a separate unit of account from the CC activity and would need to be assessed against the IAS 38 criteria for capitalization. However, whether or not it might be eligible for capitalization, we think will depend, unfortunately, on the specific facts and circumstances. So if we think about the key takeaways here, if you have a significant SaaS project underway or one that was done recently, you need to look at the activities in detail to determine if they're part of the CC or if they're separate units of account that need to be considered under IAS 38. And secondly, it would probably be a good idea if you've already started to do this, if you're affected, because time is of the essence. And as we've looked at this, we've realized it's not an easy exercise. For more information, please feel free to take a read of our in-depth publication, which will be linked in the talking points accompanying this webcast.
Okay, let's move to the impact of climate change risk on ECL. Now, we know that there's an ever-increasing focus on risks that are associated with climate change by a range of stakeholders, including financial regulators and investors. And so it's becoming increasingly important, frankly, for entities to be able to demonstrate how they've considered the impact of climate change and whether that consideration had a material impact on the financial statements. What I want to focus on today is the impact of climate change risk on the measurement of expected credit losses under IFRS 9. Now, we know that the IFRS 9 expected credit loss model requires that reasonable and supportable information that is available without undue cost or effort be taken into account in the calculation of expected credit losses. Now, if we keep this principle in mind, what it means is that entities will need to consider how climate change risk may affect the assumption as well as the other inputs that are used to measure expected credit losses. Now, we know that borrowers could face a range of physical, regulatory, and reputational risks that ultimately impact their credit risk, but also increase the likelihood that they may be unable to meet their debt obligations. Additionally, the value of collateral against which loans are secured could fall, or that collateral, those assets, could actually become inaccessible or uninsurable. So when considering all these impacts on ECL, I want to focus on 5 key considerations for our audience. So number 1, entities need to think separately about physical risk and transition risk. By physical risk, I mean the risk of destruction or temporary disruption of that physical asset from the increased incidence or severity of specific climate events, such as weather events. The transition risk, on the other hand, is just the advancement or the displacement as a result of moving to a greener or more sustainable economy. Number 2, entities need to be mindful of duration. Now, while change is happening fast, longer-term exposures are likely to be more affected than shorter-term ones. Number 3, entities need to recognize that one size just doesn't fit all. Different portfolios are going to have different risk exposures depending on duration, industry, geography, and in many cases, only top-down assessments of vulnerable geographies and industries will be possible. Number 4, entities need to avoid double counting risks by considering the extent to which those risks might already be captured either directly or indirectly through model inputs such as market credit spreads, expected default frequency, or other factors. Number 5, entities need to consider other arrangements like insurance, guarantees, government subsidies, or any other sources of recoveries, including how those sources or those arrangements are structured, but also how their providers are actually thinking about those evolving climate risks. Now, we know that these ECL considerations are certainly important to banks, but are also important to corporate lenders, particularly those with exposures to industries that are most significantly affected. But let's take a deeper dive into specific areas of the ECL model under IFRS 9. There are a few of them that I want to highlight today. Let me start with reasonable and supportable information. Now, I've already touched on that, and we know that under IFRS 9, information used should be reasonable and supportable. Now, whilst at a higher level of judgment might be required in assessing what information is reasonable and supportable, it's not impossible. And so there is need for judgment, but it does not mean that there is no information that is reasonable and supportable. So an entity should really make an effort in good faith to estimate the impact of those uncertain future events, including second-order effects on the credit risk of financial instruments and the resulting measurement of those expected credit losses. Another area of focus is historical data. Now, historical data should be adjusted based on the current observable data to reflect the current conditions. Now, entities should be mindful that historical data, particularly when considering longer-term impact, may not yet reflect the estimated future conditions that may arise as a result of climate change. For example, the effects of flooding might be included to some extent in that historical data, but maybe the frequency or the severity is lower than what may be possible in the future, and that may necessitate an adjustment to that historical data. Another area is collective versus individual assessment. Now, management should consider whether the ECL assessment is performed at the appropriate level. Now, when a sector is impacted by climate risk, an entity cannot yet determine individually which borrowers in that sectors will be impacted. The collective assessment should be performed to ensure the risk is still captured in the ECL estimate. And if not incorporated into that instrument level ECL model, an overlay or post-model adjustment, what we call a PMA, may then be needed. But let's not forget that in addition to all this, previously homogeneous groups may now need to be disaggregated into subgroups, where climate risk, for example, is causing differing impacts. Another area is assessing significant increase in credit risk. Now, entities should have regard to climate risk, again, when assessing whether there has been a significant increase in credit risk, which may impact the staging of the asset. Now, there's a couple of questions that entities could consider. For example, have there been any other changes in the terms or the rates? For example, lenders may now require new covenants related to green or sustainability measures. And the introduction of those more stringent covenants could now indicate a significant increase in credit risk. Are there any existing or forecasted adverse changes in business and economic conditions? For example, new climate-related regulations, carbon taxes, or even changed customer behavior that may adversely impact the borrower's business model and could indicate a significant increase in credit risk. Another area is multiple economic scenarios. So ECL is determined by evaluating a range of possible outcomes, as we know. So even if climate risk impacts are not considered likely, but they're still possible, they should be considered under the ECL model and should not be ignored. Now, the inclusion of climate change factors and risks could also necessitate a change in those scenario weightings, particularly if that introduced different nonlinearities. And last but not least, the area of focus is disclosure. Now, where all of the previous considerations lead to material updates to the ECL model, the impact of climate change and where it has been considered should be disclosed in accordance with IFRS 7. So, for example, explaining any changes made in the estimation techniques or changes in the assumptions. Now, model adjustments, particularly in the context of longer-term assumptions, such as climate change risk, are often very difficult and subjective judgments, so disclosure is critical. And where individually or taken together with the other elements of the ECL estimate or model, there's a significant risk of a material change in the next financial year related to climate change, then this will also require disclosure under the critical estimate guidance in IS1. So those are the key considerations. Again, it's a very important area, so I encourage our listeners to focus on that within the next coming months.
Hi, I'm Paul, joining you from Sydney. Thank you for the opportunity to speak with you today about impairment reversals. Last year, a lot of companies recognised impairment loss due to the economic conditions resulting from the impacts of COVID-19. I wanted to take this opportunity to remind you today of the main principles to consider when looking at impairment loss reversals. For all the assets that have been impaired, other than goodwill, IAS 36 requires entities to assess at the end of each reporting period whether there is an indication that an impairment loss may no longer exist or that an impairment may have decreased. Looking for indicators of reversal will require judgment. If there are any indicators of reversal, the entity needs to recalculate the recoverable amount of the asset. There is an exception for goodwill. IAS 36 states that impairments of goodwill are not permitted to be reversed in any circumstances. Subsequent increases in the recoverable amount of goodwill are likely to be an increase in internally generated goodwill, and this recognition of an internally generated goodwill is prohibited by the standards. IAS 36 includes example indicators that should be considered when assessing whether an impairment loss may no longer exist or it may have decreased. These indicators mainly mirror the indications of a potential impairment and are also grouped into two categories: external and internal sources of information. A reversal of an impairment loss should reflect an increase in the estimated service potential of an asset, either from use or from sale, since the date when the entity recognised the impairment. Entities should identify the change in estimates that causes the increase in the estimated service potential. Please note that an impairment loss is not reversed just because of the passage of time, even if the recoverable amount of the asset becomes higher than its carrying amount. Impairment losses should only be reversed if there has been a change in the estimates used to determine the impairment loss. For example, a change in the future cash flows for value and use, or a change in the asset's fair value. The passage of time, also known as unwinding the discount, will also increase the present value of the future cash flows, but IAS 36 does not allow only the passage of time to trigger a reversal of impairment. The easiest example of this is a cash flow model with an outflow in the first year. After the first year, the NPV will increase because there is no longer the outflow in this model, but this is not a reversal of an impairment. Also, it is important to highlight that subsequent growth of the cash flows in line with the expectations incorporated in the cash flow model when the entity recognised an impairment loss for its assets is not an indicator for impairment reversal. The indicator for impairment reversal could be evidence from internal reporting that the economic performance of the asset is or will be better than expected by the model. The growth could also be the result of expenditure by the entity to improve or enhance the performance of the impaired CGU, or as a result of restructuring of the CGUs as a reaction to the pandemic, the impact of which was not included in the earlier impairment model because it was not committed to and not recognised as a provision under IAS 37. There may be an improvement in the service potential that exceeded earlier expectations, and entities could consider this fact as an indication of impairment reversal. The amount of any reversal that can be recognised for an individual asset is restricted to increasing the relevant asset's carrying value to the carrying value that would have been recognised if the original impairment had not occurred. That is, after taking account of normal depreciation that would have been charged if there had been no impairment earlier. The reversal of impairment losses to assets of a CGU is allocated to assets other than goodwill on a pro rata basis, based on the carrying amount of each asset in the CGU. In allocating the reversal of an impairment loss, an asset's carrying amount should not be increased above the lower of its recoverable amount, if determinable, and the carrying amount that would have been determined if no impairment loss had been recognised previously, adjusted for subsequent depreciation or amortisation. The reversal should be recognised in the current year's profit or loss for assets accounted for under the cost model. The reversal of an impairment loss for a revalued asset should be recognised in profit or loss to the extent that the original impairment loss, adjusted for subsequent depreciation, was recognised in profit or loss. Any remaining balance of the reversal should be recognised in other comprehensive income. Thank you for the opportunity to connect again, this time on impairment.
Great. Well, let's talk about pollutant pricing mechanisms now. Entities have become increasingly alert to the financial consequences of climate change and the measures being employed to tackle it. In many territories, emissions credit schemes have been a key tool for reducing emissions. Most of the emissions trading schemes cover carbon dioxide emissions, and their fundamental purpose is to encourage reductions in such emissions through incentivizing companies that engage in carbon neutral or carbon negative activities and stimulating investments in those businesses. Some businesses may be more carbon intensive, but the aim is to effectively offset such emissions by reducing them to the extent possible in other businesses or promoting activities that otherwise offset emissions. Emissions trading schemes and consequently pollutant pricing have been around for some time. However, this matter is again becoming a hot topic, no pun intended, for a few reasons. The price of carbon credits has generally been increasing around the world. This means that such programs are becoming more material to companies' results, both for those that need to purchase credits to meet compliance obligations and for those that are generating credits to sell as part of their business activities. More businesses are getting involved in generating carbon credits. Some have sought to diversify their energy mix. Many conventional energy companies have expanded into wind or solar energy or investing in carbon capture technologies. The impact of carbon emissions trading is becoming increasingly critical in the economics of various businesses and investment decisions. Of course, many entities are more focused on reporting on carbon emissions as part of their ESG disclosures and are working towards their own carbon targets. In some cases, the carbon credits generated by such activities can help to defray the cost of these initiatives. There is actually no specific accounting standard that deals with accounting for emissions trading schemes. IFRS 3 was intended to address the accounting in this area, but it was withdrawn in 2005. There are some complex conceptual accounting questions about the nature of obligations arising from pollutant pricing mechanisms, especially when the entity receives emissions allowances from the scheme administrator for no monetary consideration. There are also questions about whether, and if so how, to recognize assets and liabilities arising from pollutant pricing mechanisms. Furthermore, the International Accounting Standards Board, or IASB, is consulting on its work plan for the next 5 years, and there is an opportunity for companies to share their views on this topic, since one of the potential large projects identified by the IASB is pollutant pricing mechanisms, which would deal with emissions trading schemes such as the EU ETS and possibly other systems. We published a trouble entry accounting survey in 2007 together with IETA, the International Emissions Trading Association, which still has some relevant guidance on the accounting we saw back then. We are working on a revised version of the survey, which will be comprehensively updated with the latest statistics on the accounting, and hopefully you'll see that soon. The withdrawal of IFRS 3 means there are a number of accounting models that can be used under IAS 8 for accounting for participation in these schemes, and there continues to be significant diversity in practice in this area. Although withdrawn, the IFRS 3 model remains a valid interpretation of existing IFRS. I'll call this the IFRS 3 approach or a full market value approach, and we'll illustrate its model application alongside with two other models that we see in practice, the cost of settlement approach based on the initial market value and the cost of settlement approach based on the nominal amount. So let's start with the accounting on the asset side. Under all three approaches, the initial allocations are treated as a government grant of an intangible asset. However, under the nominal amount approach, the asset and the government grant income are both measured at a nominal amount, which is usually nil. Under the full market value and the initial market value approach, the asset and the government grant are measured initially at fair market value at the date of initial recognition. They might subsequently be remeasured to fair value if a revaluation model is selected for these assets where there's an active market for them. The government grant income is then amortized over the compliance period on a systematic and rational basis. The intangible assets recognized are not amortized but would be tested for impairment. On the liability side, the measurement for the emissions obligation will differ depending on the model selected. Under each model, the liability is initially recognized when the obligation arises, that is, when the liability is incurred. Under the full market value approach, the liability is remeasured based on the market value of allowances at each period end, irrespective of whether they are to be settled using allowances on hand or purchased from the market. Under the initial market value and nominal amount approaches, the liability would also be remeasured at each period end. However, the liability to be settled using allowances on hand is measured at the carrying amount of those allowances, which for the nominal amount approach would usually be nil. Any liability to be settled in excess of allowances on hand is measured at the market value of the allowances at the period end. In some cases, an entity might enter into a forward contract to buy allowances at a fixed price on a future date. In this case, it's permissible to recognize a provision with reference to the forward contracted rate rather than the prevailing market rate, because this is the best estimate of the amount that the entity expects to pay to settle its obligation. Forward purchase or sale contracts are treated in a variety of ways for accounting purposes, depending on the facts and circumstances. The main question when accounting for these contracts is whether they fall within the scope of IFRS 9 financial instruments, which applies to contracts to buy or sell a non-financial item, where the contracts can be settled net in cash or another financial instrument, or by exchanging financial instruments. And often these are referred to as net settlable contracts. Contracts to buy or sell emissions allowances could be examples of these types of contracts. Such a net settlable contract will be outside the scope of IFRS 9, where the contract to purchase or sell the emissions allowances was entered into and continues to be for the entity's expected purchase, sale, or usage requirements. This is commonly referred to as the own use exception. An example of own use in this context might be a forward contract to purchase emissions allowances that the entity enters into and continues to hold to meet a shortfall in the entity's emissions obligation. That is, where granted allowances and/or purchase allowances held by the entity are less than the expected number of allowances required to meet the entity's obligation for a specific period. However, entities should carefully evaluate and assess that all the criteria for own use are met based on the terms of the contract, the company's continued intent for physical settlement, and its past dealings with such contracts. Where a net settlable contract does not meet the own use criteria, or an entity uses the limited exception provided by IFRS 9 not to apply the own use criteria, it will be recorded at fair value through profit and loss by default. However, an alternative treatment to fair value through profit and loss accounting might be to apply cash flow hedge accounting, whereby the change in the fair value of the contract is recognized through other comprehensive income. The adoption of this approach is subject to meeting strict application criteria within IFRS 9 for hedge accounting and requires documentation at the outset of the hedge. Contracts that are not net settlable contracts are outside the scope of IFRS 9, although such contracts should still be reviewed for the presence of embedded derivatives.
We've covered a lot of ground today, and we hope you found this webcast helpful. With 2021 coming to a close, it's important to recall any requirements that will be effective for the first time in December 2021, and there are two worth mentioning briefly here. The first is the accounting updates as a result of the IBOR reform and the replacement of LIBOR. We've discussed this in previous Q3 2020 and Q1 of 2021 webcasts. So if you think this will impact you, please do take a listen to those webcasts or read our in-depth in the link under this video. And the second is amendments to IFRS 16, which make it easier for lessees to account for COVID-19 related rent concessions, such as rent holidays and temporary rent reductions. Please listen to our Q4 2020 webcast, where we've discussed the impact of the amendments on the lessee and on the lessor. And I also wanted to highlight where to go for additional resources. On Viewpoints, you'll find a lot of additional information on the topics we've discussed. Thanks very much for listening to us today. Best of luck.